Holy guacamole, what a quarter and what a day for earnings. As many of the stocks that I was very interested on watching today's earnings are dropping hard. But obviously today we're going to talk about Wish, as many of you have asked me to talk about Wish before any of the other companies. Hello everyone, welcome back to the channel. Today we're going to talk about Wish earnings. I have not listened to their earnings call as it is 4:30 right now, and their earnings call is in 30 minutes. So I might tweet about it or maybe do a community post. Now, I do have to say that today is crazy. We can see here that Wish is down 18% after hours, SoFi 11.86%, the two chef 10.59%. Disney is the only one that's up 5.28%. Not the only one. The only one out of the four that I was interested on. Today I'm gonna talk about Wish, but I'm gonna post a video about the two chef and Disney tomorrow and maybe over the weekend as well. Now let's get into their earnings right away. First of all, we can see here that Context Logic EPS missed by 4 cents and misses a revenue as well. Now, as you can see here, when they start with all this essay, we know that they have a lot to explain. So I know that I highlighted a lot of things, but everything is very important. As you can see here, they already reported a revenue of $656 million, missing their own expectations and analyst expectations. Core marketplace revenue of $378 million and product boost $50 million. Logistics revenue $228 million, which is slowly growing and taking share out of product boost and core marketplace. Will be higher than core marketplace in any minute. Now, demand slowed down to a number of headwinds. We are implementing a plan designed to ensure the long-term success of our platform. Revenue declined 6%. It didn't grew 4% as they were expecting. It declined 6%. Logistics revenue did increase 126%. It's not that over 330% that they grew in quarter one, but it's still 126% growth, which obviously is very, very good. Now, their marketplace revenue decreased 29%. They expect the user retention to improve, but now that we have a more reliable logistics, but instead it declined. And obviously, as they said here, they are not satisfied with this result. No one is satisfied with this result. We can see that the stock is dropping hard. The second quarter of 2021 was already going to be a challenging year-over-year comparison, as during quarter 2 2020, as they said here, they benefited from the pandemic. A lot of people were at home between March and June when everyone was at home buying a lot of things. Now here, from a macro perspective, as vaccine rates increased, stay-at-home orders began to ease and all that, daily user activity and active buyers on our platform declined more than we had anticipated. So they were obviously not anticipating any of what happened this quarter. They saw a 13% reduction in app installs and a 15% reduction in average time spent on our platform in quarter 2 compared to quarter 1 2021. So they're not comparing to 2020, to quarter 1 2021. Now at the same time, cost of digital advertising increased more than expected as they had a decline in engagement. Also, the recent privacy changes for iOS have caused more advertising to shift spend to Android devices. This drove up competition for advertising bids. This rising digital advertising costs contributed to lower marketing efficiency, which obviously is not good at all because it increased their expenses in marketing, and we know they're already spending a lot of money in marketing. Now, they are implementing the following initiative that they believe will improve the user experience and increase retention, as the retention is very important. First of all, they're enhancing product quality and selection, as obviously that's necessary. Under a new quality score system, we are now prioritizing products and merchants that receive positive ratings and feedback from our users. Second, providing an unmatched fun and entertaining shopping experience, as they are investing to develop a more engaging, personalized, and discover-based online shopping experience for their users. Improving the performance of the app, as that is very important because 70% of their sales come from their app, so they need to have a perfectly performant app, and this lower the platform performance impacted the user experience, particularly for our existing users. Now, their core marketplace decreased 32%. Active buyers during the quarter declined 44% year over year, and on a year over year basis, core marketplace revenue decreased 21% in Europe and 44% in North America. As that is huge because we know that over 80% of their revenue comes from the United States and Europe. Now, this here is very important. We know that Wish obtained a payment service license from the Dutch Central Bank, which enables us to process transactions and increase control over the payments value chain, while also reducing reliance on third parties, which obviously is way better for them because they can accelerate the process and also reduce costs from the third parties. Now, the best part of this is that long term, they can convert into a fintech company as well. Long term, we might decide to bring additional financial services to the European market. Obviously, they are not offering this right now, but it is definitely a target long term. Now, for the product boost revenue increased 11%. Logistics is another thing that I like about Wish, which logistic revenue second quarter increased 126%. We already knew that. Wish has built a program that allows merchants to outsource all of their logistic needs so that they can focus on running their businesses and benefit from Wish volume discounted rates. These locally based merchants usually can ship products faster when they opt into our Wish Express shipping solution. Wish Express listing increased 291% year over year during quarter two. Generally have an average time to door of under 5 days because they are being shipped from local merchants or a China-based merchant who has forward deployed inventory in bulk into the user's local market, which is obviously excellent because this is what people are wondering. People don't like the quality of the Wish products, even though the people that use Wish to buy things, they already know what they're paying for. But now they're not only improving their quality, but they're also improving their timing. Now, the user metrics, total monthly active users, or MAUs, declined 22% year over year. And I'm laughing here because I know that tomorrow we will see a headline talking about the lawsuit against Wish because of the MAUs, and now that declined 22%, they're going to talk about this. I'm very, very sure of that. Now, we believe that decline in MAUs was primarily driven by a decrease in overall mobile usage, as obviously stay at home is over. Not over, but almost. People are back to work, kids are going back to school or to college and not using their phones or their computer 24/7 as they used to during the pandemic. Now, their outlook, they obviously do not believe the quarter two performance is reflective of the strength in our platform and what this company can achieve, which obviously is kind of a relief for us because they know that they did not perform right and they need to improve, which is obviously a good sign. Now, the actions we're taking to improve executions and the user experience are expected to strengthen Wish's operating performance. We do not expect this new initiative to contribute meaningfully to positive year-over-year results before the second half of 2022, meaning that the things that are trying to improve right now, we're not going to see any results out of them until second half of 2022, meaning that their stock will be very volatile until then, as their quarters will not be the best ones. Now, they have solid cash, and we know that. We're going to check their balance sheet right now, that they can use that cash to navigate this turnaround with a goal of returning to the growth. They can use that cash, reinvest it into their company, and start growing back again. I know that it's difficult to understand this, but we cannot compare 2021 with 2020 because 2020 was a crazy, crazy year, and even more for e-commerce. We already saw that Amazon also missed revenue expectations. They delivered 113 billion, and analysts were expecting 115 billion because 2020 was an outlier year. We cannot compare 2021 with 2020 2020 where everyone was at home. I'm not saying to not compare it with other companies. I'm saying this with e-commerce industry because they saw huge growth in e-commerce. I said last year that in an Amazon video. I didn't know if they were all going to be able to maintain that kind of growth through 2021. And now we're seeing that they're not able to. We can see that Wish did not do good. Alibaba did not do good. Amazon missed expectations as well. Now here we can see that they have $1.4 billion in cash and cash equivalents, 1.7 total assets, and only 800 million and almost 900 millions in total liabilities. So they have a very healthy balance sheet, and they have more than enough cash to reinvest into their company to continue seeing a massive growth. Now, let me say something. I'm investing in this company in the long term. I do want to say that obviously this was not the best quarter ever, and I understand that I cannot come here and tell you guys that the best quarter, that don't care about this. Obviously I care about this, but these things happen with companies. We've been talking about Wish earnings on my Discord group chat, which is completely free if you would like to join, because we saw how Amazon did and all the e-commerce. So we were actually expecting a bad earnings report, not this bad, but we were expecting a bad report. We all know also that the market likes to overreact. Now, I do have to say that I like how they are trying to expand and increase and see a nice growth in logistics and fintech. That is going to be good for the long term. I understand that they had a decrease in revenue and a huge decrease in their core marketplace business, but I do expect in the long term that they will do good. I do understand that it was not their best quarter. I would like to wait and see until how they do for the second half of the year, but I know that sometimes this type of companies do not have the best quarter, but in the long term, I'm focusing in the long term, and I believe in this company in the long term. I might be wrong, but I know that this stock is very volatile, and I do not recommend anyone to invest in this company if they cannot tolerate the risk, because it is very volatile, and we have seen that it is down over 18% already, as all the other high growth stocks that I just mentioned. Also with Fubo TV, that even though they went up massively yesterday because they did excellent, is a high volatile stock, and I do not recommend anyone to invest in these stocks if you don't know the risk that you have by investing in these companies. Hope you enjoyed the video. Please smash that like button and subscribe, since it really helps the channel out. Thank you, and see you next time.